Welcome back to the Kingscrowd podcast. I'm your host, Brian from Kingscrowd, joined by Scott Kitun. Every week, we're breaking down the latest in the online private markets. We chat about stuff relevant for investors, whether you're a founder raising capital, anywhere in between, marketing agency, platform. This week, Scott figured we could do a bit of a recap. We've had a couple big events over the past couple weeks. Hopefully everyone was able to tune into the Kingscrowd Investment Crowdfunding Week last week. It was an online virtual event where we had just all the who's who of the industry were there over 3 days. We had company pitches. We had a lot of really good fireside chats. We were able to, Scott, you and I, do a couple sessions ourselves. So we'll do a quick rebrief and recap on that. Also, 2 weeks ago, so prior to that, I was actually attending a crowdfunding conference in Malaga, Spain, and wanted to share some of my findings and just realizations about the European investment crowdfunding market, some of the differences, a lot of the similarities that we see in the US, and we can kind of dive into that. First, Scott, so ICW 26 was last week. I thought it was a great time. We had just awesome people, awesome guests, good pitches from companies, kind of culminating in the championship round. I won't spoil it if you didn't watch it, so you can go and watch that recording to see who took home the $5,000 investment from Kingscrowd. But what do you think? Any big takeaways for you from last week in any of the sessions or any of the chats or anything else that you hosted?
Yeah, I mean, first, huge shout out to Sam Fisk and Chris Martin behind the scenes. They made the thing run like a well-oiled machine, pushing 1,000 RSVPs or something above or below, just slightly that. Very impressive. Well before day one launch, they had already surpassed last year's attendance, which, on a virtual thing, this is very hard to do. We have a niche industry, so there's a certain type of people who are always going to be interested, but then to branch out and start growing different people, I thought they did a really good job of exploring and expanding into different asset classes. In particular, mine was about creator that I did with you. So sort of the creator revenue, creator as an asset in itself is one. And then we talked with Darren Ravel in my second one about collectibles and just like where that's all going and kind of the fine blurry line between, collectible investing and collectible hobby investing. And how to kind of make sure you don't get yourself tied up too deep in that, but also can participate and have fun and still see some real returns. It just is a matter of recognizing if it's a professional investment, contribution to what you're doing, or if it's just for fun and it happens to also make money. Overall, I really enjoyed it. I feel like there are so many different. I think a lot of I'll put it this way. I'll set this up for our conversation today. A lot of years were spent either calling crowdfunding unicorn hunting or calling it something, which I'm sure you're going to talk about with the EU, as something more like SMB focused, way to like kind of raise a little bit of money. And I think what we're starting to see happen is that it's like, it's kind of like a buffet. It's like old country buffet. You come in, if you want fried chicken, it's over here. You want the lettuce, the salad bars over here. You want soups, it's over here. If you want, wine and whiskey, which you subscribe to alts.co and see those guys, Stefan and those guys and Wyatt write about it all the time. They've got a huge interest. Some are hobbies, some are investing for actual capital. You've got people who are SMB, you've got ag tech, you got product, you got medical stuff, which is like totally different. You got it's all over the place. And then doesn't even include the entry point for us now with Creator. It doesn't even include collectibles and cards like Rally Road Fractionalized. It doesn't include investing in golfers. I just saw that Chisos, which was doing sort of the invest in a person's revenue, lifetime career revenue, is now pivoted to Chisos Golf. And they're basically doing the same thing that FinLeet was doing for baseball, but for golf. There's all these things. And so what it's telling me is that there's a regulatory infrastructure that has been created that it's kind of up to you how you want to monetize and use that, whether that's individually, create your own, solo GP, invest only, be a portal, all these things are all coming around. And there's just a lot of, maybe we should be looking at this industry in aggregate, as opposed to being like, did we fail at being the startup investment replacement or whatever the case may be? So that's one of the things that I learned during this was it's like the pure breadth of assets. And some people are using it for investing in random collectibles and literally didn't even know that it's like a place to invest in startups. Like they just were, I'm here on Vinovest or whatever, and like didn't know. Like that blows my mind.
Yeah. I'll give a shout out to one of the sessions I was a part of. It was compliance and knowing the rules. And shout out to the SEC. So Jeb Byrne from the SEC was a part of that panel. I think it was a great discussion. We had him there. We had Andrew from CrowdCheck to give kind of the practitioner side of sort of the implementation of that. And then we had Jason from Digital Niche Agency to give some of the marketing input, like on the communications and rules, and Greg Burke. So that was a super diverse panel, but I think it was, again, okay, I say, regulations and chatting about compliance, most people's eyes probably glaze over, but please, if you are in the industry, like check out that session, because there was a lot of really good stuff shared. And to go back to your point, Scott, the point is that this framework, right? So the exemptions that are like regulation crowdfunding in the US and regulation A, that opened up this possibility to be able to invest in all these different assets. When we talk about it, and I say we collectively, a lot of times you'll hear, oh, hey, it's not successful because I'm a venture capitalist and I look at this and I see some of these companies that are raising, it's breweries or mom and pop shops, and I say that's not investable. So therefore, it's a bad asset class. On the other side of things, you get these SMBs, the small businesses like mom and pops, and they look at it and they see some of the high growth startups like Mercury Bank and some of these others, Substack, that raise, and they're like, this is not at all for small businesses. You have to be a big startup, a hyper growth, VC backable company, and it's not able to be able to raise in capital at a good cost of capital for us. So my point is that we can't talk about it in aggregate as just, this is investment crowdfunding, it's working or it's not. You really got to kind of look at it in all these different verticals and kind of different groups that are using it. And it's not only those, but like you mentioned, it's creators, which is completely different than, the racehorses, than the rev share royalty deals with films or video games. Like there's just so many different assets now that you can't paint with this broad brush and talk about it in aggregate and say it's working or not. Like you got to really think about, the different parts of the buffet to go back to your analogy, right? What is it that you want? But I think that's one of the big things that we have going for it, is that there's so much flexibility in how these exemptions are, that we can innovate and try all these different things, that is not just one size fits all, or it's not just for the venture backable companies or just for the SMBs. You can try all these different security types and new novel security types, or different ways of having revenue sharing, which is really interesting. So yeah, that was one of the sessions I was on. I also, just to kind of bring this into discussion, another thing that was in the news in the past couple of weeks now is that talking about some of these collectibles, but StartEngine announced they acquired Vinovest. And Vinovest was basically, for those who aren't aware, a company where you basically invest in wine, right? And then they hold the wine. This is not like a $20 $2 chuck type thing. This is very nice wine bottles, right? So think about fractionalizing some of these nice wine bottles. They hold it, they store it for you. If you want it, they can send it to you. But StartEngine acquired them, which again, I think just goes to show it's, one of these different ways of getting into this industry. But I believe it was announced, or at least I saw somewhere, it was like 15 million kind of all stock deal. But any quick thoughts or reactions, Scott, on the Vinovest acquisition? Like, why do you think StartEngine acquired them? Are they looking to get into the wine business, or customer like acquisition? Or
it's trending.
Both, something else?
I would like to call, and I think I don't spend a ton of time on StartEngine scrolling. Also, before I talk about Vinovest, I just want to say to your point about the panel you did on compliance, I took the easy road a long time ago in saying that my most interesting part of this space is the regulatory. It allows you to do a lot of things that all the other regulations don't really do. And you can go to you could go to qualified purchaser accredited, and you can invest in whatever, but even there you kind of can. And so that's why you're seeing some of these private market groups using Reg CF and Reg A Plus to do some of this stuff. So I still to this day say that the biggest disservice we did was saying unicorn hunting, because we sort of hung a brand on crowdfunding when the brand was crowdfunding allows you to do its infrastructure, allows you to do things that you couldn't do before. And so the fact that we are here and everyone has their own different flavor of it, I think was the point. It should have been the point. So we can have SMBs. It was just every single platform was told that, and they raise money this way, which is a different problem. but they were told that they're going to be the X for agriculture, the Y, they're seeders for EU, they're this, they're that. And the reality is like, maybe we just needed one that can allow everything. And Dealmaker kind of became that. They may have their niche, but like they did kind of become we'll just take care of this in marketing for you, which leads to why Vinovest. I would liken Vinovest and the angle of approach of StartEngine very similar to the angle of approach of Republic with their movies and entertainment. Republic, because it's kind of a crypto tokenized, that's the angle that they took, the mirrors and so forth. They're much more in the entertainment space. And StartEngine has always had its sort of like, you knew it when you saw it deals. They're all very similar type of, be medical and this and that. And I think you get a lot of people who probably write a little bit larger check. And then if that's the case, they probably have a little bit more hoity-toity interests, of which whiskey and wine collection are those. And my suspicion is that like they're following some trends. Right now, one of the things that's trending is collecting and owning. Similar to 2020 through 23, it was the card craze. We're in this, I own obscure bottles and people like to talk about that kind of stuff. I have my own questions about the Vinovest model. And honestly, somewhere on the internet, you can find it. I did an interview with Technori with the founder of Vinovest. It's out there, where I asked him all the same questions, which is basically like, if it's just fractionalized, does it work the same way as like Masterworks? Because in my opinion, it doesn't. The fact you can't just sell the bottle unless you own it. If you own the bottle outright and that's what we're here to do is to just buy that, it works fine. But in something like in vintages, wine or whiskey or other, they tend to come and go. Some are extremely rare and they always are really good. And then there's some that kind of trend based on stories. And, LeBron James will be seen with a certain bottle of wine with Kevin Durant and all of a sudden it's popular, but you're not in control of selling it. And so that's the problem. Unless these things can be sold, I assume they will be sold on the secondary of StartEngine. That is where this becomes interesting. I'm not, as I've said many times, I'm not super long on the portal business in Reg CF right now. I don't believe that that doesn't mean everyone's going to go under. I just don't think it's as big as it's going to need to be a $2 billion company or whatever StartEngine is. However, if I were StartEngine and it was a stock deal and I could acquire a handful of things that make my platform more interesting and would allow for people to buy and sell things more easily, more frequently, I would do it. And in this case, you really can't lose from Vinovest because you're absorbing, you already have all the technical requirements. You already have all the regulatory and compliance requirements. So you're absorbing nothing. You're just absorbing those who used to go on the site and buy and sell wine. Now they're going to do it on StartEngine. That's how I view it.
Yeah. The secondaries angle is actually something that's interesting. I don't know if that was on my radar. I don't even know if that's something they're considering, but it makes sense.
I would only say that, Brian, because of Gigastar. I would never have posited that prior to my experience at Gigastar. Now I look at it and it's like, what's the one thing everyone's interested, both issuer and investor on Gigastar? And it's treating creators based on trend. Like if they're looks maxing and that's their thing and that's popping, then if your lifestyle, you're going to pop and people want to buy it and sell it. And if you're the other way, it's just kind of steady Eddie, people stick or get out of it. That volatility, it's not volatility because it's such a small amount of volume, but relative to startups, it's really volatile in that there might be multiple trades in a month, that kind of behavior and that's an important piece. And last part of it is I liken it to the Republic movie stuff. Because it's very similar. You get a type of person who's very interested. They probably have very high repeat tendencies. Your hope is that you'll get them to invest in some other stuff on the platform. You know that if they're interested in wine, they probably have some money. So there's a behavioral piece to this that I think does make sense. And when your company's at 2 billion paper trade and you buy at 15 on paper, in paper, it's free, at least to me.
I mean, the customer acquisition, if nothing else, right? Like that's probably a benefit too. Like you said, you're getting people who like investing, probably have some disposable income. Oh, right. Hey, maybe I didn't know about StartEngine. Now you can check it out. Right. But let's segue that into the next part of the discussion, because one of the things you're kind of mentioning is this branding I won't say it's a problem of the industry, right? But it's a consideration where every platform that launches kind of has a different way that they're talking about it. And so to take a step back, 2 weeks ago, I was at a conference in Spain that was the International Conference on Alternative Financial Research for Crowdfunding. And basically, it was a bunch of people presenting papers through, a lot of them were kind of EU focused. So I learned a lot about the European crowdfunding markets, but it was worldwide, it was global. We were invited to go and attend, and we're actually part of a panel discussion that we talked about data standards, because in the EU, there is no equivalent to kind of what we do for the US markets, right? In terms of Kingscrowd and having this awesome consolidated data set, we pretty much learned that every single company over there, if you want to do research as an academic, you have to partner with a platform. That platform, if you're lucky, is maybe launching like, sometimes they said like 5 or 10 or maybe a dozen deals per year. So they have very scarce kind of like data to be able to do things. And it's really hard to be able to do research kind of at the same scale that like we allow it at Kingscrowd. But anyway, going back to this, we were talking about what are challenges that the European market has that are similar in a lot of ways to what the US markets are. Platform sustainability absolutely came up as one. Is just, the business model, especially if you're only launching 5, 10, 15 raises per year, it's hard to create a sustainable business model. Now, there are a lot of differences in the market over there. So as a high level overview, we're not going to go into like detailed EU crowdfunding regulations, but they have something called the ECSPR, which is basically their Reg CF for all the European Union, which basically launched in 2021, and it lets you raise kind of cross-border. So if you're within the EU, it's kind of their way of allowing you to invest and raise capital across border. Now, a couple of the interesting things about the EU, though, while there are some markets like the UK, Italy, different places like that, that have equity deals, I told people over there and some of the researchers, I'm like, yeah, most of our deals, 90% are equity crowdfunding, right? 10% are debt. They said it's the flipped over there. So they have kind of the 80-20 rule where 80% are debt and 20% are equity, which I thought was interesting. Different investor type, kind of different type of issuer. We can talk about, some of the potential reasons behind that. But the other thing, as you were mentioning, is around this branding perception. And this came up several times in the discussion where in the early days, especially like when some of these platforms in the EU were getting started, it was crowdfunding. Everyone was saying, hey, this is our crowdfunding platform. And more of the marketing was just more broad, more general about, hey, we're unicorn hunting. This is, invest in the next Uber, the next Facebook. It was that sort of thing. It's pivoted now, right? Where the crowdfunding term is being somewhat avoided, and whether that's because there's kind of a stigma to it or they're just finding that it appeals to a broader crowd when you say things like startup investing, or in their case it might be more things like private credit if you're talking about like debt deals and that sort of thing. So yeah, I think I noticed, just as like high level takeaways, they're dealing with a lot of the same things we are. They have a current 5 million euro cap. They're trying to increase that in a similar way. We want to increase the 5 million cap over here in the US. But Scott, yeah, wherever you want to take that, branding, platform sustainability, what do you think?
I mean, branding is always an issue. What did you call it? It's a condition. What did you say? It's not a problem. It's a whatever you said.
I don't remember what I said, but I know what you're referring to.
There's absolutely a line there. I mean, first off, and we're not the first people that cover this, and we're not from Europe, so if we're shitting on Europe, I apologize. Not a great time to do that, I guess. But Harry Stebbings, who's like European zone, Britain zone, London zone, he has covered this a lot. Not from the crowdfunding perspective, but from the startup perspective. If you're saying invest in startups to those in Europe, that's not a compliment. Like, it just isn't. They don't have a very innovative. I'm not saying there's not startups there that are successful by any stretch. And obviously Europe is huge, right? So we're not talking about one specific country. The EU has, for better or worse, had an issue with innovation ever since the data privacy. If you look at the Facebooks of the world and the monster companies that have come out of social, what people use today, they all treat our data and our information like it's their own, and it's a huge problem. And arguably, Europe has done the right thing for its people, but the wrong thing for its business and its kind of venture tech community. And as a result, you just don't have a ton of startups. And if you did, it's probably not like going to get a lot of people running. And the venture community there is also again, I'm not saying that they're not good ones and they're not there, but it's just not the same as here. And it's not remotely the same. And Harry has talked about a ton that like he's built there, but does most of his business here. And I think, it's just very difficult to build a brand around something the same way we did when everyone here was startup culture, founder, the hustle porn era of entrepreneurship where everyone who's a founder is a rock star. They didn't have that. They had so-and-so built a business. It's slow growing. They need capital. They have revenue coming in. They're trustworthy. We'd back it. No one there, in my opinion, is expecting 100 or 1,000x return on this. They're expecting to get their money back plus. And arguably, the fat and happy era we had in the US of venture, which has proven to be basically bullshit for most people because there's no IPO market, which we've talked about a ton. And AI has basically taken SaaS and broken it over the knee. So even if they didn't do it on purpose, those investments are just not going to be what they once were worth, right? So I would argue we're about to enter this era for a different reason in the US where people want yield, they want DPI, they want IRR high, they want to invest in things that have one of two things. Either they are already producing income and there's distributions possible, or they're 1,000x, right? But that's investing in the next SpaceX, robotics, military drone, crazy stuff. Like it's the deep frontier tech. And I would argue here right now, we don't have a ton of it's a huge gap, put it that way, between normal venture that used to be even 5 years ago and today. It's deep tech, and then it's kind of, there's not a whole lot in the middle. And I think we're also entering a space. This should be where we pivot and talk about crowdfunding is going to make a huge rise because there's a lot of capital demand and there's not a lot of things to invest in. But the unfortunate part is that AI has also eaten into that, not on purpose, but it has, because the people who previously would have come to us and raised capital don't need it because they can vibe code or build something with no employees. And what used to take $100,000 from mom and dad and $1 million after about 6 months from outside investments to kind of hire your first CTO, co-founder person and do the things. You don't need to do that anymore. Claude's my CTO. And until I'm production and scale ready, I'm probably not hiring anyone like meaningful at that point. It's created a whole thing here in the US, but in Europe, they just never had that. Like they never took that approach. They've never got in that position. And so that is just a huge difference. We branded as Startup City. They branded as credit and debt, small business, sound investments. And but of course that impacts the volume as well.
That is not to say, again, there aren't some equity platforms in the UK as well. Like I know Italy has a lot, like right. I said UK, in Europe. So yep. UK, Italy, different markets. But yeah, I think it was just enlightening where my assumption going in and talking to some of these academics and doing their research was that it was going to be a similar breakdown, but it was really a lot more debt. Now, that being said, I think that, so going back to the conference real quick, just a few other key takeaways. There was some interesting research, presented through different places. They were looking at, for example, if a venture capitalist invests in a deal, is that a signal to retail? Like there's things like signaling theory and different kind of academic things that the academic crowd will be used to. But they were looking at some of these different impacts. There was some discussion and kind of a whole afternoon about the impact of AI, right? Whether it's using AI to generate your campaign page text and different kind of studies around some of that. So some of the research presented was pretty interesting, pretty applicable. But overall, my kind of takeaway is while there are differences in terms of the breakdown and everything else, they're struggling with a lot of the same things, that like we are as an industry here. It's came out, everyone was super bullish, like, hey, this is going to be the future. Everything's going to be done through investment crowdfunding. And we're kind of 2 decades in now over there in Europe, really kind of came out around like 2010. So we're getting up on like 15 plus years. It still hasn't really lived up to the potential of most people. And so those kind of discussions around, why do you think that is? But I think it will be interesting. What was the
prevailing reason of why? What was the reason from the insider's perspective that they feel? You don't have to like necessarily say the specific reason if there was one, but it's like the overall, why do they think it has not been as big as it could or should be? Was it an excuse, do you think? Or was it like a legitimate, you could point your finger at and go, that's a problem?
No, I think a
or an
lot of it
opportunity?
was, well, for them too, they didn't have this unified framework until 2021. So they were kind of more fragmented, but it was kind of similar to what the US was before we had this federal exemption where you could
Yep.
do it state by state, right? It was a bunch of little experiments. It wasn't so much that. So to that question, I was chatting with a few of the folks after that session when they were saying, why don't you think it has kind of lived up to what it was? And right, the observation that I brought up, which a lot of them agreed with, is that let's say you're an investor, Scott, you have an app, right? You probably invest in most of your things through one, maybe two or three different apps. Nowadays, in a single app, you can get your ETFs, your retirement accounts, stocks, options, futures, prediction markets. We basically have finance and like investing, like what you do as an investor, all in one place. Except when you want to go and invest in, private companies, you have 80 different platforms that you need to create an account on each one. Like we make it really hard. And I understand there are the regulatory and other reasons why we do it, but we've taken it and it's just completely separate from where all the other investing stuff happens. So my personal kind of response to your question is like, we can't make this more mainstream until it's way more integrated where it's with all the other things that you're investing in, right? So maybe that is like, hey, you log into your brokerage account, you can see some of these, opportunities, but or go to Kingscrowd, and if you could invest across all the places, right, with one account versus needing 80 different logins. But there wasn't one individual reason that was kind of mentioned. It was a bunch of different reasons. It could have been between that, like honestly, we still haven't had some of these huge successes. So one of the things that came up over there was Brewdog, which for people who are familiar with that story, that was kind of the poster child of like, hey, this company was crowdfunded. Like all these companies, all these investors are doing really well on paper. Well, kind of come to find out, like it did not have such a good outcome for investors as a lot of them found out. Now, what they would say, right, is that, hey, a lot of those investors were they were going to the brewery. Like you were getting more than just the investment out of that. It wasn't a pure financial thing for those investors. But like another reason, like personal belief for me is until we start having like actual investor successes and like companies that are built that are like generational companies or like companies that become household names, we still haven't had that. And so most of the people who are investors don't even know about this. I think it's an awareness thing where it's just, there's all this like vernacular you have to get understand. And that is, if you don't have the education, the background, it's just like, I'm not going to take the time to learn what all this is, or why do I need to create a separate account? Why can't I invest in this through my brokerage? It's just a bunch of extra steps that until we can kind of like do that, it's not going to become more mainstream in my opinion. But what do you think, Scott? Because I'm sure have a hot take. So
you don't want to
why
know.
don't you think investment crowdfunding has lived up to its potential thus far?
I think that retail investors are unreliable, and I don't mean that as an insult. It's not. You're not a professional investor. You're not going to wake up every day and the first thing you do is make sure before you pick the kids up, before you do anything, you check that number. Like that's not how you operate. I think that there's Republic at one point said 3 million investors in their platform. StartEngine claims even more than that. WeFunder is somewhere in the same vicinity. We've had 30, 50,000 investments go across just Gigastar alone. Kingscrowd's got its 30,000 subs, whatever, 10,000 users, blah blah blah. I don't think it's an issue of number of people. I think the thing in circle around is repeat. Why don't people repeat, and why are check sizes so small? And I think the problem is, you and I have talked about this for going on 5 years now. The venture capital, and this is speaking to US kind of only here, but like the venture capital unicorn hunter approach is a high volume approach. You need to invest mathematically a certain number of investments at a certain price point with a certain expected outcome in order to make up for all the bad ones. And if you're investing in $200 or $100 or $50 or $80 at a pop and you're doing it randomly and not repeatedly, you're not going to happen. And if you invested in one and expected that like my $100 is going to turn into $1 million because you didn't know the difference. Someone's talking about unicorns and you hear the word billion thrown around. And you're like, well, billion, shit. That must mean $1 million to me at least. Of course, I only did invest $100. So the expectations are off. And then it takes 8 years later and your $100 is still parked somewhere or gone. And maybe let's just say, and we haven't even had this big outcome yet, but let's just say there was one. What do you get on 100? 1,000? 10,000 if you're like incredible, like a multi-billion-dollar IPO, and assuming that you got your paper out. Like it just is not enough for a retail person to keep their attention. And I'll never forget this. I did a survey when we were doing, we were running stuff for Kingscrowd, and I did a survey with a bunch of people. This is right before Republic did the Hamilton Lane thing, and the survey was effectively, if I gave you $1,000 and you could make 5% to 8% annually, on this very, it's not liquid but quarterly redemptions, but it was like not in, it's not going up in smoke. Put it that way, okay? It's not one of the private credit deals that you're hearing about, Blue Owl, whatever. Or you could just put money on random casino item or random, Magic win the over tonight. Like if that's it was 80% of people said they would just do that because it's instant outcome. It doesn't even have to do with the outcome financially. It has to do with the instant outcome. It's done. It's over. And I think that there was all this like hype around startups exiting and big IPO, Robinhood, blah, blah, during the beginning of our US version of this. We've not seen any of that success. If anything, we've seen the louder bangs are the ones that are bullshit companies that go up in smoke or run off with money, more of that than anything. So then they come in and really like all of this is just about the investor type. If you are a regular person who's just putting money here and there, you're like everybody else, instant gratification. You're on the apps all day. And this is not that. And they thought they'd put money in, they'd get rich quick maybe, find one, get lucky, and that'd be it. And I say this with a lot of conviction because of one thing. I have met as many venture capitalists as just about anyone I know. And I have, through Technori and WGN, shout out to the shirt, and Kingscrowd and everything else in between, I've interacted with tens of thousands of people, regular Joes. And I would be very hard pressed to tell the difference intelligence-wise between the venture capitalist and the regular Joe. The VCs get it wrong more often than they get it right. Most of them are idiots, frankly. And I know regular Joe people on the street who, in my opinion, know just as much or more, or just as smart, just as quick, just as wealthy as some of the VCs, and they can't get it right or wrong. So I don't think it's that they don't know how. I don't think that some of the companies on our platforms are great, but we've definitely had plenty that are good. It's not all garbage. So to me, that just tells me it's like a weird product market fit. We've gone all this time later, and the problem is all the portals and platforms raised a lot of money at very high valuations under the presumption that there's this high volume of investment, and we're going to make money on both sides. We make money on the investment, we make money on the issuer. This is how this is going to work. Unfortunately, the volume never got there, and it's not going to get there because of the way things operate. And so I just don't think that market works that way, which again is not an indictment in saying bad things about the future of ECF as a regulation, because that's a different thing. I think that the future of solo GPs and being able to offer up, get in any investment across anything you want is all going to come off of Reg CF, ECF. I think the ability for all these people to go on Robinhood, to your point, and get a unified app experience and invest in Robinhood funds is going to be the result of them raising a Reg A plus fund and you being able to participate as a retail investor. All these things are still incredibly important. The regulatory piece of this is incredibly important. It just hasn't worked out on a retail to platform. That's all. That's not an indictment on the space or industry. It takes time to figure out what people are going to do.
Yeah, I was almost just going to say exactly that. Of if someone just tuned in for like the last 10 minutes, they're probably like, wow, these people are super bearish. Like, who are these people? They're saying that crowdfunding is doomed. Both of us are here and we're building because we believe in the future of this industry. I think, to your point, it's that it did not live up to the huge volume expectations of this will be the future where every single person's going to be investing in the startups. It's not for everybody. And I think that is the point. Like, to do this successfully, like you pointed out, even if I'm investing $100 a deal, you need to have that diversified portfolio. And listen, like, if you can invest in 100 companies, I'm using a crazy large number, right? And get a couple of those big outliers to have like really good IRR in your portfolio, whether you invested $100 or $1,000 per deal, you got a 30% IRR, say. Like, that's a good return. The difference is that, yeah, if you're doing $100 per deal, you need to understand the return is going to be commensurate with the amount that you started with. So you're not going to have $1 billion outcome. This is not the lottery ticket if that's what you're looking for. And I think some of these investors were more fair weather people who maybe thought it was more of the lottery ticket and are now realizing it's not. But that is not to say
that's the retail thing, right, Brian? Like, that's the retail problem? Like what happens in public markets? Like Bitcoin is like the greatest example of this of all time. Like everyone's sitting there at 85,000 going, this thing's worth, going to go to $1 million if it's on sale at 45,000. And those same people, if it dropped right now, it's at 73 or 75 or whatever. It's actually up today. But like, if that thing dropped to 40 today, there'd be people jumping off the roof.
Absolutely.
The same people who said it's on sale, hodler or whatever the fuck they said. Like that whole thing. Retail investors don't have diamond hands. Like that's just not their makeup. And also, I think this is really important to the space. I hope people learn from this. We want entertainment. I am Retail Joe. I want to be entertained. It's got to be fun. This isn't my job. My job is boring. I don't have fun there. I want to have fun here. So you can't give me something that doesn't move and it just sort of like, well, hit send, got a bill, never heard again. Like it's got to be fun. And that's, I think, the part that people, banking on this volume, they took what they knew about private investors and they just said, what if I just let everyone have that ability? Like they'll act the same, and they won't, because a private investor wakes up probably cranky, has black coffee, and then does this shit all day long. And the retail guy's like, I'm just looking to have a good time. I want to meet some people. I want to invest in Brewed Dog and go have a beer. Like it's just a different type of person. And so I think we're learning all 50 ways not to be successful. And that doesn't mean that the space won't be successful, and it doesn't mean that there won't be probably more creativity than ever come out of it.
It's been hugely helpful to tons of companies that otherwise wouldn't have gotten capital, right? And there are investors that have had some really good returns.
So glad you said that.
We're not saying it's not a failure to everyone. It's just it hasn't been at the scale, I think, that it was put out to be at the start because of that volume. So.
You just made a killer point. I just want to double on it real quick. Like expectations are everything. If we talk about startups and I say you just said there's really plenty of good companies that wouldn't be able to raise money on their own and they wouldn't be able to do this and blah, blah, blah. If you want to just blank out all the companies and people who have raised money for ag tech and robotics and, Blendtopia, that's when I invested in it, exited, and I made money on that. Trust and Will was a Super Bowl ad. They took their money back, those assholes, but I invested in them early, and I did get like a 2.5 return on that. So it wasn't in less than a year, by the way. Like there have been good companies on here. If you're only looking for unicorns, then yes, your opinion of this is bad. If you take EU into consideration and you look at some of the other things, you're like, wow, I actually could have been making 8% all along. You could absolutely have been making 8% across ECF stuff if that was all you cared about. And by the way, you'd be close to beating the S&P any year except for this year. So I don't know. Is it bad? Maybe it's just badly framed. How about that?
Yeah. I mean, I think that's a great place to sum things up. We're not going to stop talking about this. I'm sure it's going to come up on a million more episodes after this. We've spoken about it a lot in the past already, but it was
we've become the most popular media platform in the space. We're not giving up the throne, Brian. Don't be silly.
Well, I think so the people watching this, especially if you're still around, you are not that fickle retail person who, invested once hoping to become a billionaire. We know that you're building a diversified portfolio. You care about picking those investments. You're helping your clients raise capital. So that's why we are here each week to bring you, all this news in terms of just what's happening in the markets, what's moving the markets, how do you be successful in this, and like where is the future of this industry going? So any last words, Scott?
Brian, like if your friends are one of the fickle few who was a retail investor who left, go tell them there's all kinds of cool deals still out there, because I actually think those people would invest in these deals. This is on us. The people who worked in this space framing it poorly. It's not on the retail investor. I use that as an example because it's true that they tend to be not reliable because they're not professional investors. But like, if they had been told, you can go find deals from creators to wine to whiskey to cards to companies to golfers to pro baseball players to startups to you can go to Kingscrowd right now and use the portfolio tool that Brian on this show built for you and put all your stuff on there, and you will absolutely find you can make positive returns here. it's a good business. It was just poorly branded. That's all. It's not too late. That's what I think.
Not too late. You heard it here first. Not investment advice. Do your own research, but we believe in the industry.
Definitely not.
Scott's here building with Gigastar, helping out Kingscrowd. We are huge believers in Kingscrowd, so that's why we're here. All right, we'll sign off there. Thanks, Scott. Another great chat. And again, for anyone who missed Investment Crowdfunding Week, head to kingscrowd.com/ICW26. You can check out all the recordings of the great events that we had, hosted by yours truly, Scott and myself, and many others. So we'll see everyone back here next week for another great Kingscrowd podcast.